The consumers facing the CPI squeeze. We're being forced to choose between what we want and what we really need. And we're going to show you why cooling inflation is actually bad for stocks. The CPI was released today. That's a consumer price index on a year over year basis. That's at 2.4%. Now, the CPI had been rising continuously for quite some time, but this really does accentuate a reversal we've seen. We certainly are on the downturn in terms of prices. That should be good. Core CPI, excluding food and energy, those are the more volatile components of the CPI report. On a year over year basis, that's at 2.8%. We were trending in the 3.2, 3.3% level, seemingly almost for about a year or so. But that's all changed. We've seen a dramatic drop in core CPI as well. Now, there's a growing divergence between the sectors reported within the CPI survey, what we need and what we want. On the left hand side, shelter and housing, we need that. Owner's equivalent rent up 4.4%. Rent to primary residence up 4%. Overall shelter prices, they're up between the high threes and low fours. On the other hand, energy and transportation on the right hand side, that's down. Gasoline down 9.8%. Fuel oil down 3.3%. Take a look at airline fares down over 5% on a year over year basis. Now, breaking down each sector, we can see this pattern does continue between what we want and what we need. We need food like meat, poultry, fish, and eggs. That's up 8% since this time last year. Gasoline, that's a little bit more discretionary. That's down 10%. Coffee, up 7%. Airline fares, down 5%. Rent, up 4%. Fuel oil, down 3%. Shelter overall up 4%. Lodging away from home. It'd be nice to take a vacation. That's down 3% since this time last year. Services up 4%. Durables like washing machines, heavy appliances, things that need to be financed down 1%. Medical care up 3%, transportation down 1%. So we're seeing a growing divergence as the consumers being forced to choose between what they really need and what they want if they could afford it. Now, we've invented a new economic indicator. It's called coffee versus airline fares. In red, that's CPI coffee on a year over year basis. In blue, those are the prices for airline fares. And what's very interesting to see is that coffee, for the better part of the past year or so, has been stronger or rising at a faster rate than airline fares until pretty recently. On the right hand side, the Dow Jones Industrial Average. Well, take a look at this. The similarity in patterns is really uncanny. We're taking a look at June of 2023. Notice on the left-hand side the divergence between coffee and airline fares, that coffee was rising quite a bit faster than the price for airline fares. In other words, what we need is better or more important than what we want, airline fares, and if we can't afford both, we have to opt for coffee. Well, at the same period of time, the stock market was in a range-bound pattern. It wasn't really, doing very much at all. But then we fast forward to December of 2024. Take a look at the peak on the right hand side for the Dow. On the left hand side, that's when airline fares, that discretionary purchase, actually those prices increased more than coffee. Point being is that when the economy is doing well, or if the stock market's doing well and there's perception of growth, maybe we'll spend a little bit more in discretionary items, discretionary spending, like airline fares, for example. More recently, though, we've seen a huge downturn in stocks and also a huge downturn in the price increases, the inflation found in airline fares. Inflation is rising in non discretionary sectors like housing, food, and services. But discretionary goods and energy related costs, they're stagnant. And I think that really sort of reflects not only the stock market, but the overall economic condition. When we don't have enough to buy both discretionary and non discretionary, we have to opt, of course, for the non discretionary, those necessities. Now, again, on the left hand side, CPI, right hand side, core CPI, we've seen dramatic drops in both measures. So it's not an anomaly and it's not just related to fuel or food. That certainly is the case. While falling prices are good for the consumer, this can reflect weakness in the economy. After all, if prices are falling, are they falling because raw material prices are falling? Well, we have PPI, Producer Price Index, tomorrow. But is it rather that the demand, the consumer's ability to consume these goods and services, maybe that's what's waning. Maybe that's what's driving these prices lower. We've spoken about this chart quite a bit lately. In yellow, S&P 500. In blue, those are the probabilities the Fed will not cut interest rates in June. There's a very strong correlation, and both recently have dropped precipitously. Stocks have been very weak, and also the probability that the Fed won't cut rates, that has also dropped. Meaning, if the stock market's dropping, the perception is the Fed should cut rates to stimulate the economy. Now, why do we mention all this? Because as inflation is cooling, the CPI, core CPI is cooling, this leaves the door open, or at least leaves the door open for the Fed to get a little bit closer to a rate cut. And a rate cut would be the result of cooling inflation and or weak economic growth, weak job growth. Now, tomorrow, PPI, Producer Price Index, that's the cost of goods at the wholesale level. And then we also have, which is very important, consumer sentiment. The reason why we mention now, we usually don't talk about consumer sentiment, but it seems to be the driver these days of the economic calendar, even more so than the big numbers like CPI and PPI, because consumer sentiment is what we experience at the stores. It drives the decisions that we make, whether to consume or not to. And that lately has not been good at all. So it's going to be very interesting to see not only wholesale prices, but also consumer sentiment. We hope this has been helpful. We look forward to seeing you back soon.